Hi everyone, Megan here from Third Space Accountants. I'm just going to run through a couple of tax tips for business owners today. So, we're coming into end of financial year. We want to make sure that one, we're not paying too much tax. Two, that the tax we do have to pay is money that we've sort of either got there already or we can work towards getting that ready and put aside. So, couple of things we're going to cover is one, the structuring. So your structuring makes a big difference as to how much tax, where the tax gets paid, that kind of stuff. So we'll run through some basics there. We've got the maximizing your deductions, so making sure that you're not missing out on anything, and you're not paying too much tax. And then third is just looking at the big picture. So some people have the mindset of, I don't want to pay a single dollar in tax. That's probably not going to propel you the most in your business and life wealth journey. So we'll talk through those things. All right, structuring. So sole trader, company, and trust are the three main trading entities that people will be operating through. Now, there's pros and cons to all. We probably won't dive into everything today, but ultimately, if you're a sole trader, you've got quite a lot of risk. It's often the first point that people will go into when they start a business because it's cheap to set up. Um, the tax implications of a sole trader is any money that business makes, you will pay tax in your individual marginal rate. So if you're earning a little bit of money, you'll probably pay less tax. If you're earning a lot of money, you're going to be paying more tax. A company structure, if it's operating as a small business entity, will have a flat 25% tax rate. So there's benefits there. If you're earning sort of upwards of maybe $150,000, $200,000, your marginal rate will in your individual name will surpass that 25%. So there's some benefits there, as well as obviously asset protection side of things. Then we have got trusts. So a trust will not pay tax in its own right. It has to distribute any profits out to its beneficiaries, and the beneficiaries will then pay the tax. So a trust structure is very popular in Australia. Family trusts, you probably know a lot of people in business that operate out of family trusts. That is because they will be able to potentially distribute money out to different people within their family, and not have all of the income in one person's name. So you can see that would utilize a lot of different people's marginal tax rates and give them a bit of a concession there. So the structure is, there's a lot of variables to decide what is going to be the best structure for you, but that's sort of an overview on the tax implications, I suppose. But we can obviously go into details around your specific structure. You can use combinations of these. You can have one. There's a lot of different ways to do it to make sure that you're getting the most out of it, in terms of not paying too much tax, but also having your assets protected, and the sort of estate planning and long-term goals of the business, whether you're going to be trying to sell or hand it over to family, all that kind of stuff. So second, maximizing deductions. So there's a couple of things here. So small business asset write-offs. Now, during COVID, we obviously had quite a big $150,000 cap. So anything under 150,000 you could write off. That's now been reduced down to $20,000. So there is still that small business asset write-off there, but it means that generally motor vehicles are going to be above that $20,000 mark, which was the main thing that a lot of people were writing off. Computers, smaller equipment, all that kind of stuff, instead of depreciating it over a couple of years, you can just write it all off in one hit. So that's a big one. Second, you got superannuation. So superannuation is actually a tax deduction. If you put money from your business and you contribute it into your super fund, or whether from your business, from your personal side of things, you can claim a tax deduction for that. Now, your super fund will pay tax at 15%, But if you're sitting at a 30% tax rate, so you're still getting a tax savings of 15% there. So that's a good one. I know for a lot of younger people, they kind of steer away from that maybe because they can't access the money for 30, 40 years potentially. But if you've got the cash flow there, it is a good tax minimization strategy. Motor vehicles. Now, with motor vehicles, you got to make sure that you've got your logbooks and you're claiming and running through all of the business costs there that you can deduct. It's all the running costs. If you've got a work vehicle and you're using it for work, and you've done your logbooks and you might get your logbook come back at 80% work usage, that means you can claim 80% of the fuel, 80% of the rego, 80% of the insurance, 80% of the interest on the loan, everything, right? So the key is just keep track of it, do the logbook, keep track of your receipts throughout the year. Bad debts. So bad debts is essentially you've done an invoice for someone, they haven't paid. It's been 12 months, it could be longer. They've not paid, you've chased them up, and you've basically decided, stuff it, I'm not going to ever get that money. If you don't do anything about that, you've reported it as income when you initially did the work and you did the invoice, and you've paid tax on it at that time, right? You paid GST, you paid income tax because you reported it as income. If you get 12 months down the track and you realize I'm never going to collect that, if you don't record it and write it off as a bad debt, you are just going to pay tax and GST on money that you've never actually received, right? So what you want to do is record all your bad debts. Do a 30 June review on all the money that you're owed and clear off anything that is overdue and is not going to be collected. That'll reduce down your taxable income. Then we've got your receipt management. So that's pretty simple. You want to keep track of all your receipts for this stuff. If you don't have receipts for things, it's going to be potentially tricky to claim it with the ATO. And if you get an audit, then they're going to knock back everything. So make sure you got your receipt management systems up and running. There's a lot of technology out there now that will do all this heavy lifting for you. So utilize that. And then lastly, we've got the big picture. So ultimately, if you're not paying any tax at all, it means you're not making any money. So, I don't know anybody in business that wants to not make money. So that just seems crazy to me. I think the key to this is making sure that you're paying the right amount of tax and you've got profit there. One of the big issues we see people run into here is they deduct everything under the sun. They report that they've made very little income. Great, because they're not paying hardly any tax. Bad, because they can't borrow any money to go and buy their house and buy investments, do all the things they want to do, right? The bank don't like you if you don't have any income. So that's probably just a big thing to keep that in mind when you're, claiming deductions, when you're trying to sort of get creative, I suppose, with what you're running through the business. But yeah, this is pretty generic advice, obviously. But if you do want to have a chat with us, talk through your specific situation, map out a bit of a tax planning strategy, just reach out and we'll book in a session. All right. Thank you. Bye.